said we'd start, so we might get cracking. Welcome to Q3 webinar. My name's Luke Laretive. I'm the CEO and among other things at Seneca Financial Solutions. As always, I'm joined by my colleague and Ben Richards, who's the investment analyst on both the small and large cap products. Just as a reminder for everyone, we run these every 4 weeks, for about 4 weeks after the end of the quarter. Once we've got all the numbers in, it's just an opportunity for us to, I suppose, give people an update, as well as, give you guys some insight into, what we're thinking about and how we're making decisions at Seneca. It is pretty informal. Feel free to use the Q&A, stick any questions in. Larissa's in the background moderating, so we'll try and answer as many or all of your questions if we can, if there are questions. And 20 or 30 minutes. We're going to spend a bit more time on smalls and large cap today and a bit less time on the multi-manager stuff for no particular reason than we think it's a bit interesting at the moment. So, we're going to do it. I'll quickly run through the multi-manager stuff now and we'll get started. So just as a bit of a reminder, and, we get a mixed bag of people turning up to this every quarter. So just sort of a refresher for those who are new. We run 2 products at Seneca, the Seneca Australian Shares SMA and the Seneca Australian Small Companies Fund. They're the 2 products where Ben and I primarily work on and choose the individual shares that go into those portfolios. One's focused on the large cap end of the market, the other one's focused on the small cap end of the market. We also run at Seneca through the investment committee process 5 what we call multi-manager SMAs. So that's us picking 4 to 8 fund managers from each asset class, essentially to help our clients get exposure to parts of the market where we're not the experts at selecting the investments. So that's kind of how we run our business. There's 5 of us on the investment committee. It's myself, my business partner John Bailey, and 3 independents, including Gavin, Ben, and Sam Espy. Really good people, and really enjoy working with those guys every month on pulling this all together. I might skip the benefits of SMAs this month, but they are really good if you're a HIN-based investor, an SMSF-based investor, and you're not using SMAs yet. I'd really encourage you to get in touch with me, and I can run you through the pros and cons of doing things. But from an admin tax perspective, they're the best way to do portfolios, in my opinion. The first product we're going to talk about is Seneca Australian Equity SMA. This has a 25% allocation to our large cap strategy, as well as a 75% allocation to other people who run various ASX focused strategies. We've been overweight small caps. The reason we don't own our small cap strategy in here at the moment is because we've only got a wholesale version. This is to be available for retail clients. So we own some other small cap managers who we think do a good job. We're overweight smalls in this product at the moment, and have been for a while. That's starting to finally pay some dividends, and we're really excited about what's going to happen in smalls over the next 12 or 24 months, sort of more broadly. And we've also got a bit of a house view on that. We want to be long duration in fixed income, and that macro view plays out in equities, in REITs, and our Pendle Properties Securities Fund that we own was up 15% in the quarter. So that's been a driver of performance for us this month, and 3.7 for last month, and 7 point whatever since for the quarter is a pretty good result. So that product's starting to really go well. Global Equity SMA. This is obviously investing in global fund managers. We're overweight emerging markets here, and with China ripping 21% during the quarter, that's been the right call. We were able to make a pretty timely switch from Asian managers. So we switched out of Fidelity, who've been in the portfolio for a while, and over to Platinum, after we did some work around how those 2 funds were positioned relative to each other. And we just thought that Platinum was going to be able to better capture the upside. And as a result, Platinum did actually outperform Fidelity by 1.38% during the quarter. So, that's pretty significant just for a single quarter, given that they're 2 managers with very similar mandates. So probably just demonstrating the value of the investment committee and the value of, I suppose, running SMAs rather than trying to run individual clients and get around to everybody to make these changes all the time. We can just tactically do things, get everyone the benefit at the same time, at the same price, sort of optimize in an optimal way. Fixed income's really going great. It's done this, aggressive income's done 11.7 the last 12 months. It's a bit behind benchmark because the benchmark's got some equities allocation. Equities are ripping, so it probably looks worse than it really is. I mean, if you're a fixed income investor picking up 12% return, you're going to be pretty happy. Again, the duration views here and the equity allocations are doing quite well. Relative to other alternatives in the market. Just one change for the month, adding some more private credit, taking out the hybrids, and again, sort of in line with our duration views. Let's just go to defensive. Again, like I said, if you're a fixed income investment grade bond investor and you've made 8.3% return over the last 12 months, you're going to be wrapped. So again, tactical allocation to long duration strategies, that's paying off. US Treasury bond, 20 years, it's about as long a duration as you can get. Hedge did 6% for the quarter. That's amazing in this particular asset class. So yeah, that product's continuing to do well, and you're getting sort of 9 and near enough 7% distribution yields on both of those aggressive and defensive products. So if you are an income-focused investor, more conservative investor, you could probably do a lot worse than putting your money in those two strategies. Finally, absolute return. We've had sort of trend-following strategies which were doing really well for us sort of come off. The uncorrelated strategies that we're running have been sort of average so far, and they've started to pick up again. This product's kind of doing what it's supposed to do and sort of plugging away, low volatility, positive returns. Again, probably the peer groups kicked on because of equity markets ripping, and the peer groups got some equity long short strategies, which are pretty much long only strategies or definitely net long strategies. So we tend to avoid those sort of strategies in this product because we want uncorrelated returns. We want, less than 30% correlation to markets ideally. So, when the markets are ripping, this strategy probably will struggle a little bit relative to the peer group. And when the markets are falling, we'd hope that this strategy would significantly outperform. So, look, going in the right direction and plugging away. So I've got no real concerns. From doing 3.5% over the last 2 years when the cash rate's been what it has been, and inflation's been where it is, and we've got a sort of inflation plus 4% benchmark here. So as that comes down, I would suspect that these strategies can continue to do positive numbers and uncorrelated with sort of traditional equity and bond markets. There's nothing in the Q&A, but if you want to stick a Q&A question about multi-manager strategies, now is your time. We can do it again at the end, but if you do want to ask a question about aggressive income, defensive income, absolute return, or the two equity strategies, stick it in there and we'll get to it. Otherwise, we're going to push on to smalls and then large. And I might hand over to the brains of the outfit, Benny, to talk about how he's making everyone so much money at the moment.
Thanks, Luke. So at the end of the September quarter, we've just ticked up 12 months running the Small Companies Fund. So first and foremost, appreciate the support from clients, and really pleased to be able to deliver 28.4% net return in that 12-month period, which is 9.5% ahead of benchmark. So a really strong result. In terms of how we've been able to deliver those results, we've listed some of the contributors and detractors there for the quarter, but more broadly, I'd kind of bucket our ideas into 4 buckets, being underappreciated growth, turnarounds or kind of inflecting profitability, asset plays where you're buying a dollar for 80 cents, and resources or kind of undervalued commodities. Looking at return attribution, it's kind of we've made money out of all of those different buckets. Kind of some are more stable versus volatile compared to the others. But I think that's one of the advantages of our strategy relative to some of our peers, is that we're not just kind of a one-trick pony. And yeah, just for instance, the changes there, the main change during the quarter was Global Data Center Group, or code GDC, has been, top 5 position since the inception of the fund. It owns a collection of data center assets, most notably a 1% stake in AirTrunk, which is a hyperscale data center provider. And given the high growth in cloud computing and AI, they've been able to sell the business at a really a good valuation, and GDC managed to realize substantially above book value. So that's kind of one of those asset plays that's turned out for us. And we've sold that and redeployed proceeds into kind of the new opportunity set. So yeah, we're really excited about kind of the coming 12 months. We've still got lots of companies with catalysts to play out. I've just increased my holding in the fund over the quarter, a significant portion of my own wealth, and Luke and the team's pretty heavily invested as well. So we're co-invested right alongside you, and really positive on the outlook for the fund.
I've also put in more money just at the 1st of November. So I think JB has as well. So yeah, like, I would encourage anyone else, if they're interested in the strategy and like what we're doing, reach out to me or the team, and we'll get you invested at the 1st of December intake. The fund does have just monthly liquidity at the moment. So yeah, if that is of interest, it's a zero management fee product, and we just take 20% of performance above the RBA cash rate. So with a high watermark, so it's a really fair price. It's about the cheapest small cap fund in the top quartile, if not the cheapest. So yeah, would encourage you to take advantage of that while we still offer it.
Just to talk to a couple of kind of sample ideas to get you a bit of a flavor of how we invest. First one here is Catapult. It's a sports technology business, and I think it just highlights kind of the opportunities that are available in the small cap end of the market. You can buy a market leader in a niche market, in this case being sports wearables and technology for athlete performance analysis. And yeah, it's kind of got a 20% market share in a market that's growing at about 20% per annum. So it's one of those ones where you're not going to be able to find them in the large cap into the market. And Catapult has been around for some time. It's been had a bit of a checkered history, and we've only owned it more recently as it's kind of turned the corner. New management's come in a couple of years ago. They've focused on shifting to profitability. And you can kind of see there, that's just the chart shows free cash flow in the pink line, and the Catapult share price is the blue line. So you can see that as it's turned the corner to profitability, investors have kind of woken up to Catapult and re-rated it accordingly. And yeah, it's one of few listed ways to get exposure to professional sports, which is a high growth market, predominantly private equity players involved. So there's not really many ways to play it. And Catapult is kind of one of those rare kind of niche market leaders. So yeah, we think the stock still has some more upside, and yeah, the market perception is typically slow to change on these turnarounds where the profitability is kind of inflecting, where people have been burnt before, so they don't want to rush in. But yeah, so that's the first one that we're still excited about. Second one, Luke and I spent a week in Perth and the Pilbara meeting with companies as kind of part of our research process. And yeah, I mean, clients would have seen the note that we sent in terms of some of the key takeaways and learnings from the trip. But I'll just touch on one company that we met in Perth, which was one of a number of companies we met with. And yeah, it's another one that's been held since the inception of the Small Companies Fund. And boring is beautiful when it comes to this company, XRF Scientific. It does laboratory testing equipment, consumables, and spare parts. And it's really been underappreciated by the market. I've followed this business for a number of years, but this was the first time we've been out to their Perth facility. And I think Luke and I both came away from that with our confidence reinforced that these guys have a competitive advantage that's being underappreciated by the market because it's not immediately obvious. It's not, what chemicals they're mixing together for lab testing that's the secret sauce, but it's the how they're doing it. It's the, shorter lead time and customer service, and bespoke blends. Like it's got a number of kind of things that play in its favor that when you first look at this business aren't immediately obvious. And being fortunate enough that we were able to meet with the managing director and the founder, both really good guys, know what they're talking about, aligned, invested alongside us, and just good people. So really impressed with that. And you can see the chart there. That's the earnings in the pink and the share price in the blue. So anyone that's kind of been saying that this is too cyclical or too small, any number of excuses you could throw out there, kind of continues to be disproven. So, that's a company that probably trades on about 18 times forward earnings with a large degree of recurring revenue. And, it's got 3 times the share of its nearest competitor. So, these are just kind of some of the companies that we're seeing, and we still believe that there's a large opportunity in the small caps universe. Really excited about the prospects for.
I think the only thing I would add to that is, while I'm not trying to ring around 50 or 60 clients to tell them about these ideas, instead, we're in Perth learning about them, building conviction, building greater understanding, building greater confidence in what we're doing. So, the fund structure, rather than me stockbroking ideas to individual clients, just means we're going to generate better returns for everybody. So, we've got, I think, 36 companies in the portfolio at the moment. We could have done any of those ideas with you guys today. We just picked these 2 out because we've got a bit of a story to tell about them, and we like them. But there's 36 other or 34 other companies there that we like just as much, and we think have got the same or potentially more upside. So what's our top pick at the moment, or what's our favorite pick? Well, you tell me which one you want me to tell you about. So I think this fund structure is really opening up a whole level of I suppose a whole amount of time for me, and that's only resulting in us being better at our jobs. So I think from a personal perspective, I'm so pumped with this fund, and it's been really exciting. I'm also really pumped about what we're doing in large cap, despite the numbers not looking that crash hot, with 39 companies in this portfolio at the moment. Last time we caught up, we talked about Aurora, which did 40% plus returns for the quarter, and we talked about Hub, which did 26% returns for the quarter. So I was really pleased with those additions last 3 months ago or whatever. I think the key takeaway here, I suppose, is that when we look at the benchmark performance over the last sort of 6 months, we can see that a market cap weighted ASX 200 portfolio has outperformed an equal weight ASX 200 portfolio by 5.21% on an annualized basis. If we look over a 10-year horizon, we can see that an equal weight portfolio typically has outperformed the market cap weighted portfolio by 1.12% per annum on a compounding basis over those 10 years. So it's 9.64% versus 5.82%. So, my view here is that the benchmark's sort of over-earning or overperforming at the moment, for a range of reasons that are probably a bit too much to go into on a 30-minute webinar. But certainly we're really confident in the positions that we hold. We think that we've kind of turned the corner in terms of relative performance, and I'm certainly not that upset about 13.9% returns over the last 12 months. I think that's above average for the asset class, and certainly we're moving in the right direction. So I'm not too stressed about things at the moment in the large cap, despite being sort of under benchmark over the last six or so months. The main contributors for the quarter were for the BHP and Macquarie, top end of the index again, sort of as you'd expect. And as I said, Aurora and James Hardie's been good too. And I think James Hardie's going to be really good for us in the current quarter, particularly on the back of this election result yesterday. Detractors, we had Light and Wonder with a legal issue with their major competitor, Aristocrat. and Karoon and Pilbara just on sentiment, and Arcadium Lithium was also one of the big detractors during the September quarter, but then got a takeover bid in the October quarter. So yeah, I mean that's it. Everyone sort of knows our thesis on brines, and we've written about it, talked about it, rattled on about it for years now. We thought Arcadium had the biggest and best set of brine assets anywhere in the world, and Rio Tinto eventually agreed with us. So that's had a takeover bid. It's going to go through. Cash offer from Rio Tinto is not going to fall over 8.30. I think is the current share price roughly, and I think the bid's about 8.50 on dollar terms. So we've sold out of that position now and moved on using that money elsewhere. But yeah, a really good example of, I suppose, spotting some value in some assets and then someone else eventually agreeing with us. The other company I just wanted to quickly touch on this quarter is Megaport, relatively new addition to the portfolio. They do sort of the connections between data centers, make it easy for people essentially. And it's been a stock that I have ripped on publicly many, many times for a long period of time. But probably I've got to give Benny some credit here. He's convinced me that now's the right time to be buying this stock. We've seen, profitability accelerate, the share price go down. It's on 18 times EV to EBITDA, which is a huge discount to where it traditionally is traded. No one likes it, and that's the time we want to start getting interested in stuff. So we've sort of changed our mind on it for the right price, and probably a good example of the benefit of the way that we do things at Seneca and how we are willing to change our mind about things and kind of everything at the right price. And actually, we're super bullish on Megaport at the moment, which I can't believe those words just came out of my mouth. So, credit to Benny for doing some really good work on this. And look, I'm looking forward to reporting some good gains. I think we're already up a bit there. It's sort of 7.30 now since we bought it. So, yeah, pleased with that, and think we're on a winner there over the next 6 months or so. Just on outlook, so I've been talking about this multi-year bull market. If you need any more evidence that I'm right, well, just look at the past year. If you're scared about investing in shares, you're scared about deploying money in the market. If you're not going to put it in now, you probably, you're never going to put it in. You're going to have 2-3 more years of really good returns in equities, in my view. And this is the optimal time to be deploying money. And if you are going to deploy money and you want to make the best possible returns, I think you've always got to go to the, if it's risk on trade, you want to go to the risk on part of the market, and that's small caps and emerging markets. And so we're overweight in those sectors, and we've tilted our multi-manager portfolios accordingly. So, we expect to make money there, and we're going to maintain those overweight positions. I think in fixed income, it has its place in the portfolio. It certainly, provides some good diversification and good income for people who do need it. We do like traditional bonds at the moment. We do like the duration trade still, and there's some really good yields on offer, which, relative to equity yield, if you're looking for income on a risk reward basis, from my perspective, it's pretty attractive. So don't be scared of fixed income. It certainly has its place. From a macro perspective, nothing's really changed. Our views are the same. We think the AU dollar can appreciate a little bit further from here. And rate cuts are kind of already happening in many developed markets, and probably won't be too far away here in Australia. I would say first quarter next year, in line with consensus, would be my best guess. But I mean, I think it's a bit of a fool's errand trying to predict macro. Just got to play the cards and the balls as they're bowled. We had a few questions from people. Well, I sort of picked a few questions that people have asked over the journey that I could cover, but I'm also, open the floor to you guys. Stick your questions in the Q&A. If there's nothing in there, then I'll start ranting on about these. All right. So US election results impacting our decisions. Not really, I would say. Yeah, we're paying attention. Yeah, there's a couple of companies that could be impacted. It's pretty much in the price though. So not too stressed out on that front. And I think, Australia is kind of a net beneficiary of, US protectionist policies, if that's what everyone's kind of worried about. Um, what is the minimum to invest from Lambros? So small cap fund, 100 grand, SMAs and multi-manager stuff, 25 grand. Generally, to be a client of mine, $500,000. But we can certainly help people out in the best way we can. So you just let me know, and we'll sort that out for you. HF, any change in conviction on web? No, not really. I don't know. We sold some, probably just fortuitously, before the downgrade. So yeah, I suppose there's a reduced conviction. Probably at these prices, no, I wouldn't say. Think it looks pretty good. Think probably management taking the mickey a little bit, in the sense of their incentive was set during October. Wouldn't be surprised if there's a decent trading update that sees that stock upgraded again in the near future. Peers are doing quite well. So yeah, Benny, any other thoughts on Webjet? I think that's pretty much our view, isn't it?
Yeah, I think just bearing in mind that they had the demerger, so you've got it trading under Web and WJL, so it's a bit murky. But then the Web beds has had the downgrade, so. But yeah, I mean, our views are always changing all the time on these kind of things. So
I think at the end of the day, probably the message here is, if you're not sure about the stocks you own, or you're not sure about your investment thesis, or you're kind of basing it on like what we say or other talking heads say, I'd probably argue that you don't have a good investment process, and it's not, sufficient for it's not sufficient to be making and putting your money to work in that way. I'd be thinking about more about your process. I mean, we don't ask other people's views on our stocks. Like, we don't care what anyone thinks about the companies we own. We do our own work, and we've got our own views, and that's what you pay us for. So yeah, I'd just try and also just build some more conviction in what you're doing, or pay somebody to do that for you. Wazza, do you have some favourite tech stocks on the ASX in addition to MP1? We have lots. We own, I don't know, Cat's pretty much a tech company. We talked about that today, but we've talked about RPM Global before. There's heaps. I mean, if I'd call Index a technology company.
There's I actually just recently recorded a podcast that's going to go up on Rask, hopefully in the next couple of weeks, talking specifically about software and tech companies on the ASX, and with a focus on small caps. So also that's essential listening for you. But yeah, we do have exposure across both small caps and large caps as well. Like, we own a couple of names in that portfolio too, which are, high growth, good companies.
All right. There's been a real slowdown in IPO activity. Do I think it's going to pick up, and where do we see the opportunities? We actually think you want to be investing in the IPO market at the moment. The start of the IPO cycle is always the most attractive, because the pricing is normally a bit skew-if, and that gives you an opportunity to get into stuff that may, if it came out 6-12 months later, be trading at higher prices. So yeah, in the smaller end, we're seeing lots of good IPO opportunities at the moment. We've got 2 IPOs that we've currently invested in the small cap fund that are coming to market. And we expect to see more. We've got a huge pipeline of potential deal flow over the next sort of 3 or 4 months. So really excited about some of those companies and the prices that we're able to buy them on pre-market. So if that all goes to plan, we're going to make a lot of money. So that's pretty exciting. And I'd be definitely keeping your ear to the ground for some good deal flow, or just invest in the products, and you're going to get access to our sort of pipeline. Do we still like Vulcan Energy Resources? Yes, we like it probably more than ever. But again, I'd sort of say, you shouldn't need me to tell you that the stocks you own are good. You should have some conviction in what you're doing, and whether I think something's good or not shouldn't be a concern of yours. If you want my views, like I said, we've got between the small and the large cap products, like 70 companies, or more that, 70 positions, I should say, that we think are good. So, I still like Vulcan and still like lithium kind of more broadly for the longer run. And what are our fees? So to be a client of mine, you'll typically pay 1% per annum. You'll get all your tax reporting included in that. And if you're on platform, there's no brokerage. That's really good. We can certainly help you transition that over time and manage that through time. And that's what you'll pay. If you're an external person and you've got an existing advisor somewhere else, they will pay. You'll pay the rack rates on the various products on the platform. And if you want to invest in a small cap fund, sort of anyone who's a wholesale investor can do that. And again, it's a 0.0% management fee with a 20% performance fee above the RBA cash rate. So that's sort of how it works. Any other questions from the audience?
I see there's one, Luke, on.
Oh, did I miss one? Sorry.
MinRes. It snuck through there.
Julio, can you elaborate on MinRes? Is Ellison important to its future? Can I elaborate on MinRes? Do I want to elaborate on MinRes? No, look, I do. I think people are less important as companies get bigger. Individuals, when I say people, I don't mean the management team, but I mean, celebrity CEOs, for lack of a better word, are less important. I've not been a Chris Ellison fanboy, for lack of a better word. I don't rate him as highly as a lot of other fund managers do. Maybe that's just my Perth bias and being in the bubble. I don't know. But no, not such a big deal for me. I mean, we've bought on the dip. So I'm pretty comfortable with our entry price, and pretty comfortable that we'll make some money out of that from those prices. I mean, Benny, I don't really know what else to add, but I mean, we're buying the operating business and the assets. I don't really worry about Chris too much.
I think it's probably grown to such a scale where Chris isn't, it's not hanging on to every bit of deal flow that he's doing. They've built a really good mining service business with recurring contracts. They've got good lithium assets, and they've just brought on a really good iron ore asset. So it's almost more of a commodity play, and a play on the operating business. And despite a lot of media noise, that's still going to be the key driver of earnings. So
I'd probably be more worried if I was like a WiseTech shareholder about Richard White's activities than I would be necessarily about Ellison, despite the AFR kind of getting right after it and making a big song and dance about it. But yeah, it's probably like an opinion thing. I mean, it's not really, probably other people would have a different view on stuff. So that's sort of the MinRes question. Any other ones there I've missed, Benny? Sorry, here we go. More. Cron. Thanks, Cron. Appreciate your support. One of the great referrers and great clients of mine. So I really appreciate Cron and all the investors, to be fair. You've all been fabulous. So thanks very much, guys. Look, I'm over time. Like I said, I want to be respectful of yours. So if you've got any questions, you want to catch up one-on-one, you want to have a beer or a coffee with me in Melbourne. I'm also in Sydney, 20th and 21st for the people up there. I'll be in WA over Christmas, New Year time. So, if you can catch me, between my uncle duties, I'm more than happy to catch up for a cold swan draft somewhere. But like I said, get in touch. Happy to go through things in more detail with you, or talk specifically about your situation, or anything else you want from me. Really, we're an open book. So Benny's available as well, as is the rest of the really impressive team at Seneca. So again, thank you so much for your support, interest in what we're doing. I can't believe we get 25 people turning up listening to Benny and I rant on about our stocks. So thank you so much. Really appreciate it. Have a great day.
Thank you.